Kevin Amolsch joins me again, and you can learn what we talked about last time, which was the power of the first deal, by checking out episode 520. I'm going to make sure to have that link in the show notes, as well as a link to Kevin has offered everybody a report regarding the economy. So head over to thepinereport.com, and you can learn about what his team is up to by going to pinefinancialgroup.com. Again, those will be clickable links in the show notes, but appreciate your time here today, Kevin, as we talk about the economy and what you foresee in the near future here.
Yeah, Jack, I'm excited to be back on the show. I remember having a good time the last time, and hopefully we were able to help some listeners out. So yeah, for sure, if you haven't listened to that episode, I would encourage that.
Yeah, that was a great episode. And I mentioned that my notes on that episode were quite lengthy. So there was a lot of value you brought, and I expect the same here this time around. The economy is something that, to be honest, a lot of people kind of want to avoid talking about. They don't want to reveal what they see in the crystal ball, but it is on top of mind, especially as we're going into the political season here.
Oh, yeah. Yeah, it's interesting that, well, it's very confusing because good news is bad news. I mean, you don't normally see that right now. When we're recording this, the most recent inflation data just came out, and inflation actually went up a little bit. So now there's some panic in the market, right? Because we know there's a fight against inflation. But typically when you see something like that, you would see the stock market decrease. That's been, through this process, been pretty standard. But this report comes out, it's the inflation's higher. So what's the Fed going to do? And the stock market actually went up. So, I mean, there's just so much confusion in the economy right now. It's hard to get, a good grasp of what's going on.
Well, I know, it's anecdotal, but I can tell just from the experience we've been having is that with the volatility, even with the increased interest rates, we're still seeing quite the demand for particularly certain priced houses. Is that a similar situation for you?
Yeah, I mean, housing without question has been the darling of the entire process since COVID, right? And a lot of that was the injection of capital from the government. So that really brought up, and the 0% overnight rate, but that really, brought up the housing market and the economy in that sector. But what we haven't seen is a fall off from that. And you would think with interest rates, going from in the 3s, sometimes sub 3 to 8, almost 3 times where they were, you would think that you would see some fallout there, some pain in the housing market. But with very few exceptions, I mean, year over year, even today, year over year, housing values are still up.
Mm-hmm. Yeah, it's kind of interesting. I almost want to say that what we're experiencing, because I don't know if you remember, Kevin, but we do a lot of flipping. That's wholetailing, if you will. And it almost seems like the group that we were targeting, those people that were buying $400,000, $500,000 houses, their buying power might have shifted down a little bit, and that pool for the $300,000, $400,000 houses, that appetite actually has increased.
That's right. And so it's very interesting you say that, because it's the move up prices and the high end, the higher end, that the demand has we've really seen a spike in demand. And I'm not sure if I could put my finger on why. I guess the high end might make sense because they're not really influenced as much by interest rates. It's really your starter homes, your first time home buyers are really influenced by the cost of capital. A lot of the $1 million, $2 million homes are, surprisingly, they're paid by cash. So it doesn't matter what the interest rates are. But the price point that you're suggesting, help me understand, why is that so strong right now?
Yeah, I wish I could tell you. It goes back to what you were talking about, that first time home buyer pool. And now we're coming out of winter, at least where I'm at. So this spring market is always hot, and it doesn't seem to matter what the interest rates are at this point.
Yeah, and you could see the data. When interest rates get below 7%, there's an uptick in demand. And there's a very strong, if you look at history, very strong correlation, negative correlation actually, between the price of capital and the demand for housing. So we know demand is coming because we are all anticipating lower interest rates. But what's very interesting is the supply. why is the supply at historic lows, even though population continues to grow in this country? We have like about 1 million. It's right around 1 million listings right now, which it's never been that low before.
Yeah, and I would imagine that those people, the people that are sitting on those houses, they're sitting in a house at 3% interest, and they're not going to sell that in order to go to another house where they're going to have 7-8% interest.
Yeah, they call it the lock-in effect, and it's very real. Why would you sell a house with a 3% mortgage on it? But here's the thing. And you know this as well as anybody else, life just happens. So babies are being born, there's divorces, there's marriages, there's a lot of job transfers right now. There's definitely some turbulence in the job markets. So all of that will create some supply, I would think, because it would loosen up that lock-in effect. But you're absolutely right. Why would you pay off a 3% loan?
I have seen some people suggest that can be an incentive when it comes to selling, where the people can maybe take over the existing mortgage to incentivize a positive sale. Have you seen that type of trend to where you're at?
Oh, absolutely. On the commercial side, you could do formal. There's a lot of it going on right now, a lot of formal assumptions. So there would be no violation in any agreement in that type of arrangement. But on the residential side, we're seeing assumptions also that they're just not formal. So they're more like hey, take over my payments. I'll sign the deed over to you. You take the house and take over the payments. Or like we talked about on the last episode, lease with an option to buy. If I could lease a property with someone who's got a fixed 30-year at 3%, I could probably pay them more than their mortgage payment so they can create some income while I sublease it out to somebody else at an even higher rate so I can create some income as well. So those creative type transactions are like full steam ahead right now. Let's say that.
Well, you've already kind of alluded to the fact that you're expecting interest rates to come down, but do you see anything else in the future that you can expect to happen in the market?
Oh, absolutely. So short-term rates will start coming down this year. I mean, the Fed has been very clear in this cycle what they're planning to do. They said 75 basis points is going to probably be 3 cuts. Now, could that change? Absolutely. And I would not be surprised to see any cuts get postponed until, even after the election. But what I do think we're going to see is job numbers change. A pretty neutral job market is about 5% unemployment rate. We're under 4 still, even though that's gone up a little bit. So I just think that there's a lot of room in the job markets to help get that inflation under control. So I would suspect we see layoffs and that kind of thing coming.
Yeah, the job market seems always such an oddball thing lately to me as well. Part of me I don't know if I believe that number, that 4%, it seems like there's more people around me that are unemployed than that. And I'm seeing layoffs all the time, but then I'm also seeing more help wanted signs than I ever have.
Yeah. There's just, it's the great, what do they call it? The great resignation we just came through, right? People were moving jobs. But you're right. The job numbers are very confusing for 2 reasons. One, it's a survey. So how accurate is that? 3 reasons. Second is gig workers. So any 1099. So think about your realtors that maybe went from a transaction a month to a transaction a year. Well, they're still considered employed, right? According to that survey. But they're highly underemployed, if you would say that. With the third one is with all the stuff that's going on in the economy, everything else, how do you say this? Like the fight in inflation, right? Inflation is not budging. GDP, all of these things would indicate you would see a softer job market, and we're just not seeing it. That's the job market, interestingly, is the only reason we haven't been officially called a recession.
And I hate to, I don't mean this to come off as political either, but with the amount of people coming across the border right now, do you think that is going to have any impact to the economy and the housing market?
Well, I think we'll have to see what happens after the election, because this is a hot topic. I think it's going to be part of the campaigns. But I'm a big believer in everyone should be welcome, but I just want it done legally. And I'm not trying to go political here either, but if it's documented and legal, then I think there'll be a good employment. So it will absorb some jobs. when it's not tracked, then I have no idea. Like we wouldn't know if they're absorbing some of those jobs or not.
Mm-hmm. Yeah, it's just I know that there are certain sections of the country now that are experiencing kind of a housing crisis because of the amount of extra people they're dealing with. It's just, you know how real estate works, right? We see an influx of people or people moving to a different city. We saw a lot of that during the whole pandemic. A lot of people move into Florida or what have you. We are, as investors, we're a little slow on starting the building process and getting things going to adapt to that number of people. You know, it's not a quick fix.
Yeah, I mean the numbers on the new construction is staggering. Like we're at a low historical low on that too. We've never been able to catch up on that. And gosh, what were they saying? Don't quote me on this. Don't fact check me on this one, but something like at the current pace, it would take 10 years of building just to hit where we would have to be at today. It's something crazy. Like there's just not enough construction. That's why I'm wondering, where is the inventory going to come from? You know, housing is very, very stable. That's why I'm saying it's a darling of the economy, because there's not a lot of room for it to go anywhere. It's going to be, you know, flat to even increasing in value just because of supply and demand. There's just simply not the supply.
Yeah, and it's probably one of those things like we saw that bubble in 07, 08, and I was kind of expecting a bit of that, but we just haven't seen it, and I just don't think we are.
Well, you know, all that supply came from the credit crisis, right? So all those foreclosures. So if you track today, the unemployment or the default rates is under 4%. It's never been that. That's another, there's so many, this is why the economy is so crazy. It's never been, the default rates have never been this low before. So take out foreclosures and you look at all the loans, including FHA, which has a pretty high default rate, you're still under 4%. And that's a leading indicator to foreclosures. So we're not saying the foreclosure's coming either.
Well, with all that being said, I'm going to remind everybody to go over to pinefinancialgroup.com and take advantage of what Kevin offered by downloading the free report, thepinereport.com. If you found some value in what we've been talking about so far, do us a quick favor, share this with one of your investor friends. And if you're watching us on YouTube, give us a quick thumbs up and subscribe to the channel. With all of that, Kevin, I'm going to ask you the big question that everybody wants to know. Where is the opportunities right now?
Yeah, I'm glad you asked that. So that report that we were talking about that I'm giving away, it compares what happened in 1990 to today. And the reason I chose that recession is because that one is one of few that hit housing. So I think that it's important to look at. But it's high inflation, high interest rates, right? Coming out of the 80s when we had 18% interest rates. So I think there's a little bit more resemblance to that recession than, I guess the most recent one was COVID, but prior to that, it was 2008. So we hear a lot of people, and we just alluded to it in this conversation, a lot of people talking about the 2008 crash and what can we learn from that? And does this resemble that? And the answer is quite clearly no. So that's why I went back through the recessions to see. So in that report, I'm trying to compare. So just learn what we can from history. To answer your question, where are the opportunities? Well, I think there's two things here. And I'll be very curious to hear what you think about this because, look, I don't know that I'm right. I just think this is where we're going. We know that we have a little over $950 billion in commercial asset debt coming due. And what's interesting about commercial debt is it might amortize over a 25-year period. So that helps set the payment, but they have short terms. It matures in 5-7 years, meaning that you have to pay that entire loan off in that amount of time. So if you're refinancing like we all did in 2020 and you're getting low interest rates, well, those are going to all start coming due soon. I mean, especially those 3-4 year terms are coming due right now. And you were at a 4% interest rate on a commercial asset. That might be 8% today. So twice. The problem here is that when you have that kind of change in the cost of your capital, it impacts your ratios. And the one I'm specifically talking about is your debt service coverage ratio, DSCR. It's the most important ratio to look at when getting loans on commercial assets. And what we're looking at with that ratio is, can the property afford the payments? So we're looking for a 1.2 or 1.25. That's the most common for commercial lenders. So 1.2 DSCR simply means the asset, the apartment building, whatever it is, produces 120% of what's needed to make that mortgage payment every single month. So that's what we're looking for. That's what qualifies. And if it had a 1-2 ratio at a 4% interest rate, what's that ratio now at an 8% interest rate? This is why I think that there's going to be some problems in the commercial space, not to mention the fallout of the commercial problems into banking. We've already started seeing that, right? Last March, we saw that with Silicon Valley, then Signature. And now today we have New York Community Bank, which is in the top 30 of largest banks with assets under management, and they're in trouble. I don't know if they come out of this. So what's going to happen when you start seeing commercial assets go bad and banking go bad? That's the opportunity, I believe. And I can keep going because, go ahead.
No, I can't agree with you more. The commercial space has been, before this whole thing even started, the commercial space has always been a little foreign to me when it comes to any kind of some of the stuff that goes on there just hasn't like clicked 100%. So I've been very cautious.
Yeah, good idea.
But one of those things that has never recovered is, the commercial space that you see around town. I mean, there are a ton of facilities and strip malls and everything. When those businesses closed because of COVID and they just couldn't survive, they're still empty today. And I just don't see them coming back, especially with more and more people working from home. The situation, the paradigm has completely changed. And now we have all this commercial property that goes unused, and we're going to have to find another use for it.
That's exactly right. Look, behaviors changed. We've never seen a pandemic like COVID, right? We didn't know, how do you say this? What you're alluding to, go back to work, right? You're not in the office anymore. You're working from home. That's why you see people moving into other areas, as you mentioned earlier, like where I'm at, Colorado. We had a lot of people move to some of the resort mountain towns in Colorado because they're amazing towns and they're still cheaper than Silicon Valley. But now I can work from home, so I want to go live there. So that was a behavior change. This video conference that we're doing right now is a change that came out of COVID. And then, of course, our buying behaviors. You're not seeing the retail shopping like we once did. Like, there's retailers that are in serious trouble right now. Macy's is the most recent, right? Do they survive? Mm-hmm. So because we're buying stuff online, and I know that was before COVID, but it really did magnify the issue. So what are we going to do with all this commercial space? Well, I could tell you we're funding a lot of this value add stuff. And one of the most creative, and I kind of like this deal, is that it was an old Safeway conversion. So it was a Safeway. Now it's a home gym and a swim school. And now it's performing fantastically well. So, I mean, that is one example. And we keep hearing about these office conversions, right? Are you hearing about these?
I haven't run into a lot of those, but I did run into something similar to what you're suggesting. We had a Best Buy that moved into the mall, and they left their own building, big commercial building, and they divided that into three now. There's going to be four businesses in what Best Buy occupied, and there's a swimming. They put in a pool in one, just like yours, a guitar center, and a boot barn or something. Like, it's amazing how much more they got. Four businesses now going in the same spot that had the one.
That's amazing. Yeah, all those repurposing, and I mean, that's where the opportunity is for sure. But you could buy these properties at pennies on the dollar. I mean, a fraction of what it costs to construct it. We haven't seen that. We really haven't seen that before. At least not since the savings and loans fallout. That was a pretty big impact on commercial. But yeah, it's kind of exciting right now if you can be creative as an investor. If you could see these great deals that are on like the auction sites, or you drive in, like you were saying, you're driving down your neighborhood and you're seeing empty strip malls and that kind of thing. There's opportunity there.
Yeah, it's just that finding that secondary purpose to that space is the big thing. We had another one recently switch over on the Minnesota side of the river, and it was a furniture store, furniture and carpet, like it was a carpet garage kind of a thing, huge facility. And, to handle all those carpet rolls, and they went out of business, they retired or something. And now it becomes storage units for U-Haul.
We're seeing a lot of storage units. We're seeing entire shopping malls getting converted to mixed use. So we'll say a lot of it's storage. So that's where I was going with this, like entertainment hubs and warehouse storage type things. So that even a big retail shopping mall, 100,000 foot center, something like that, storage.
I think one of those things that's interesting in the commercial space as well is that if you can find a property that you can find a secondary use for, the commercial sellers seem to be a bit more open to the concept of unique financing. They'll carry back notes. They're actually more used to that concept than a residential seller.
Yeah, I think there's tremendous opportunity on the residential side with owner carry. But you're right. It's a little scary to, just a normal person with the W-2 job that doesn't really understand real estate that well, which is the vast majority of people, right? Now, the commercial side, you're dealing with sophisticated investors typically. So they understand it. So it's way easier to communicate your creativity to them, and they're more likely to sell it. In fact, they might need to offer some type of financing to get a property sold.
Yeah, there's many reasons for that, I'm sure, whether it is they don't want all of the equity back all at once, or it's going to be pennies on the dollar, like you said, in order to sell it on a retail side.
Right. I mean, if you could offer some type of financing, the value of your building just went up. Right. So especially if you could get like low interest rate. What if I gave you a 20-year loan at a 2% interest rate? Would you pay more for the building? And so that creates some value, right? And so I think creativity on both sides of the transaction is important.
Yeah. That does open the possibilities there. I really appreciate the conversation we've had here, Kevin, because I think that creativity and that thinking through the process really helps a lot of people. Have you gone through that yourself? Can you give us an example? What have you acquired a commercial property through some creative means?
Yeah, so we do. I'm much more on the financing side. So everything we do is creative because we're private money. But for my own personal investments, I did do a 4-unit building with a 10-year lease with the right to buy it. And then as the neighborhood started changing around it, we started seeing new development projects going in. So I ended up doing a little assemblage. I put together a handful of lots all together. So this is like knocking on the doors, sending direct mail. The next door neighbor, I ended up finally getting in touch with her because I found her on Facebook and I sent her a Facebook message. But then I was able to assemble the lots and build a little townhome project. And that was my first 7-figure deal. So that was a net number to me. And it started with a creative financing strategy.
You kind of passed right over like some big stuff there, because that was a great example of what I think a lot of people might miss. When you went above and beyond to find that seller, whether it's through Facebook and went actually door knocking when you targeted an area. I think sometimes more times than not, and I hate to say this, but we have a tendency of trying to find the easy routes, whether it's through automation and a few other things. And I'm going to be the first one to say that I am a huge proponent of automation. In fact, that's what my CRM does. If you go to realdealcrm.com, you're going to see that's the core part of the functionality there. However, no matter how much automation you put into place, there still isn't anything that beats that knocking on the door or taking those additional steps that your competitor will stop at.
Yeah, and your example of the vacancies that you're seeing in the commercial assets around you, I mean, you know that's public record who owns that. It's probably an entity, an LLC or something, but you could dig in here and find someone to contact and see what's going on with the building. And maybe they want to sell it, but you won't know unless you call them and ask.
And I can't stress this enough. Until you do, the answer is automatically
yes.
no. And you're not in any worse situation. Like, get over some of this apprehension and just dive in.
Yeah, what's the worst that happens? They say no. Fine.
Right.
Call someone else.
You're in the same situation you are now.
Yeah, in fact, you're better because you put yourself out there and you learn and you improve from that.
Well, that's exactly it. You've made that one step closer to an actual yes.
That's right.
That's how I've always seen it. Is every no I get is one step closer to the next yes.
Yeah, I was
and
just
after you've experienced that cycles and that repetition, it's like anything else. The more you do it, the more you become comfortable with it, and the more you become just simply better at it.
Yeah, Jack, I was just giving a keynote presentation to a group of investors in Denver at a big real estate conference. And I was talking about this exact thing, like how many times you got to fall down and get up and fall down and get up to hit what you're trying to accomplish. And then I told the story of Colonel Sanders. I don't know if you know that one, but it's pretty powerful story. And I'm not going to share the whole thing here, but what I will share is that he was selling his chicken door to door while he was knocking on restaurant doors, trying to sell the recipe, license the recipe. He got rejected 1,009 times before he got just that one yes. That's all he needed, that one yes. And then Kentucky Fried Chicken was born.
Yeah, that's a great story.
And he was 65 years old when he was doing that.
I know. And that's always such a crazy part about this. It's never too late, right?
Right. Yeah, pretty amazing and inspiring story.
One last time, just to remind everybody, pinefinancialgroup.com. That's going to be a clickable link in the show notes, and take advantage of what Kevin is offering by collecting that free download by going to thepinereport.com. Kevin, this is, again, what a great conversation. I always enjoy talking to you, but I did change up the rapid fire questions a little bit since the last time you're on. So
You warned me about this, but you did not warn me what the questions are. So I'm ready.
So first off, what lie do real estate investors tell themselves and sometimes to others?
Well, it's a profit for sure. I mean, there's a big difference between your gross numbers and your net numbers. So quit lying to ourselves about what our expenses are, and let's be honest about what our actual profits are.
Do you have a book recommendation, or what are you reading right now?
Maybe Fund Your Flip. This is my most recent one. I just got it. It just went live on Amazon, went to #1. Super proud of that. So Fund Your Flip.
I will have a clickable link in the show notes for that as well. And that might or may not include a affiliate link. So everybody heads up. If you could go back in time and give your younger self a piece of advice, what would it be?
I just say start sooner. Even though I was 21, as we talked about the last time when I bought my first house, it's just you cannot start soon enough. They say the best time to buy real estate was yesterday. The second best time is today. I mean, I really do believe that's true. I know you're a fix and flipper, so you're playing the short term game. Real estate will make you wealthy on the long term game, guaranteed. It's the only way I know to guarantee wealth.
Yeah, and I should probably emphasize the fact that the only reason we do the wholetailing and fix and flipping is to buy the next multi.
There you go. So, perfect. That's going to make you rich.
That's what the hope is. So, Kevin, again, you've brought a ton of great value, but I'm going to leave the floor open to you. Is there a question or concept you wish we would have covered here today?
I think we went through a lot. I know it's a little unique, very different than the last time you and I spoke, right? Because now we're talking about the economy, which I honestly don't even think the Federal Reserve understands. Nobody really understands what's going on. It's very confusing. We have had 2 quarters of negative GDP without a recession. When I was in school, that was a recession. So it's a little odd. Good news equals bad news. And now we don't know. Maybe bad news is good. It's very confusing. So I had a lot of fun talking through that with you. And I can't really think of anything else. I will say this. So you guys, if you want to be successful, it's really not that hard. It takes 2 things, a lot of hard work and then being willing to fail. So we touched on it a little bit in the episode, but if you're not willing to fail, you're never going to take action. Without action, you're never going to get a result.
Well, Kevin, I really appreciate it. This is always such a great time talking to you. pinefinancialgroup.com. And I'll also make sure to have that link for your book and your free report in the show notes. But I hope you'll come back again sometime.
All right. Thank you so much for having me on again.